Hey there, John.Hunter, your mortgage hunter, coming back again this week with another video. This one is on phantom debt and its hidden risk to our economy. So what is phantom debt? It is the buy now, pay later loans that you see very often on things like Walmart or Amazon. Even some grocery stores, believe it or not, are offering this service. And it allows you to make a purchase that maybe you're not comfortable with right now, paying it all up front. Make four payments, interest only or interest free, and you can pay it over 4 to 6 weeks, right? And it sounds like a great deal, right? So it's point of sale. It happens, you can walk away with the merchandise or order it online. I've seen it on Amazon as a choice, and get your merchandise right away and pay for it later. So it actually increases sales, they say, 20 to 30%, which really means that people are buying stuff they can't afford, being willing to pay it over time. The immediate gratification generation that we have. So, who pays for it, right? Because there's a catch, right? Why would these companies do it if they're not making any money? Well, they're making money from charging the vendor like a commission or a flat fee to offer that service on their products, right? Now, it makes sense to them because they're selling 20 to 30% more merchandise. So, they factored into their pricing, right? You're paying for it just indirectly. And then if you pay late, they have late fees and interest, right? If you default or you are late, right? That's how they're going to make their money. Now, who's using it? Now, a lot of people are, right? I've talked to friends and family that admit to using it in the last couple of years. I think some people are using it responsibly and paying it back and not a problem, right? I think the vast majority probably are. And the numbers say that. But if you research a little bit more, which I've done here, it looks like the vast majority of the people who are using it really are paycheck to paycheck. They're people between the ages of 20 and 30 years old. They have other high interest credit cards. Very often those credit cards are already maxed, right? They're pushing their budget as it is. Otherwise, they wouldn't have to pay for that pair of Nike shoes over 4 payments, right? So it is a riskier borrower that is using these consistently. And here's the problem to it, right? Is that because of the way it's designed, it doesn't show up on credit reports, right? They do maybe a soft pull credit report, but maybe not. And because it's not being reported to the credit bureaus, what do we run into? You could have 10 of them from different companies, and there's no way for them to judge risk on other buy now, pay later loans because they don't talk, right? So they could be lending you money that everybody and their brother knows that you can't pay back, even if it's just 4 payments over 4 to 6 weeks. And they'll just keep doing it, which apparently they are. So, the idea here is with inflation basically eating away at everybody's budget, right? Everybody can agree with double-digit inflation. It just sucks, right? It's just everything has gotten more expensive. Higher interest rates have made buying a home more expensive, doing anything more expensive. So because of that, defaults are on the rise for everything, from credit cards to houses to cars. Everything, defaults are rising. But yet this is really growing, right? It's the issue is when people default on things, they're not going to default on their house or their car first, right? Because you got to live somewhere, got to have your car. So secured loans, so loans that are secured with property, typically are the last to be defaulted on, right? So what's first? It's unsecured loans, credit cards, things like this, right? Because these aren't necessarily necessities, right? Although they will do it for some grocery stores, I guess. But mostly it's not stuff you need, it's stuff you want. So that's where people are getting in trouble. They're overspending, right? So companies like, Credit Karma and Qualtrics, actually in 2020, reported that 42% of Americans used this service at one point during the year. That's just, to me, is a crazy number. But the real kicker to that is that 38% of them missed at least one payment, had to pay late fees or interest or both, right? Now, because this is not reported on the credit, that's where it becomes what I called phantom debt. It's just not showing up anywhere. So the defaults are those type of numbers are voluntary, right? So what do we run into here? We have an industry that nobody knows how big it is, right? To a lot of the estimates of the experts that are out there, at least what I've read, says that the industry is up to $46 billion. That's how much money is being spent there. Now, granted, that's a big number, especially considering it's debt that's supposed to be paid off with every 30 days. So that number is being turned over, right? But the bigger issue there is that it's really small compared to other debt, right? So credit card debt is 3 trillion, right? If you put that into perspective, that's a big difference. That's the only reason why you don't hear this on the news with everybody every day, and people aren't freaking out about this yet. But I'll get to here in a second on why I believe this is a risk, right? But and why this is really kind of the canary in the coal mine. So put it in a little bit of a perspective as far as when we're looking at default rate is, 38% missing one payment. That isn't necessarily default, right? Default could be 60 plus. So put it in a little perspective. During the housing crash in 2008, right, the tipping point where the mortgage defaults became untenable and really just started the flood of foreclosures and the whole market imploding was a default rate between 6 and 8%, right? Now, granted, these are really big numbers as far as mortgages go, trillions of dollars, not billions of dollars, right? That's the difference between thousands and tens of dollars, right? So obviously it had a much bigger impact on the market, but we're at about a 17% overall default rate on this money. I mean, that's a pretty big rate. Now, it's not necessarily killing our economy just yet, but where I'm going with it is, how does this affect the Fed? And I'm a mortgage guy, right? So how does it affect rates overall? One of the things, if you've been listening to my Friday updates on rates, you would hear me talking about the upcoming reports and what the reports look like. And one of my frustrations on it is all these reports are coming out from the government Bureau of Statistics, right? That basically, I believe, are smoke and mirrors, right? You have all this stuff that just seems to be very rose-colored glasses on the economy, especially when it comes to employment. And then we've had, I think, 11 employment reports in a row that were all revised downward, right? So they are picking and choosing what they're paying attention to. Well, I also think that is happening due to consumer spending. I think that these type of products are skewing what the consumers are really doing, right? So instead of slowing down their spending, they're just spreading it out, right? Well, I'm sorry, you eventually have to pay. This never works out, right? People are really, I think, hesitant to take on credit card debt because they know what it means, right? You're going to pay it back and then some. This doesn't seem so scary, but it is, right? Especially people living paycheck to paycheck. You get 4 or 5 of these because the industry is not tracking it. They're not communicating with each other. Now they've lent more than you can afford to pay, and the defaults will happen, and it's going to get ugly, I believe. And I think this is going to have more of a psychological effect than an actual effect on the market. It's not like credit card debt being so large and, say, even homes, which is even more important, right? Because obviously where you live. But it's going to have a major psychological effect. I think consumer spending, consumer sentiment, that type of thing is going to wane dramatically as the bill is called due, per se. I think that this industry needs to be regulated. The CFPB is actually on their radar. There was just a report, I read this article today in March, about how they're very much aware of the risks that are happening here. And because it's phantom debt, it's not showing up on the credit reports. There's no way for them to underwrite the risk of people that are using this a lot, right? So one of the things, like as a mortgage lender, I have to show what's called a ability to repay, right? As a lender, I can't do a mortgage if I can't prove but beyond a reasonable doubt that you have the ability to repay the loan. That's actually comes from the Frank-Dodd Act, right? It was one of the things I think makes sense, right? So those loans where we could just, because of your credit score, we can just say whatever we want as far as your income and you qualify. Because the lender can make money on the paper, not because you're going to repay the loan. That was my bitch back then, right? We were making bad loans because people were making money on it. It had nothing to do with people's well-being and living in their home and doing what's best for their family. It was all about the banks making money. This is what we're running into again. They're doing these loans because they can make money on it. It's not because of what's best for these clients. The they're not proving and they're not showing that people have the ability to repay this. You know, if you're paycheck to paycheck and you have 2 or 3 of these out there, and all of a sudden you get sick for a couple of days, your paycheck's lower, what are you going to pay? Your power bill, your car payment, your rent, food, or the pair of Nikes that you bought? You know, I think that's a no-brainer, right? And that's the whole canary in the coal mine, right? What's going to default first? The default on this is going through the roof. You know, 17%. I think that's going to get worse. We're just going to see where it goes. I think the Fed is ignoring this information. I think the statistics they're getting on consumer spending, I think, is skewed from month to month on this. Maybe not dramatically, but enough to make a difference in the Fed's policy. You know, every time they come out, they're talking about how they're data dependent. Well, if their data is flawed, then their policy is flawed. I think that by the end of the year, a lot of this stuff is going to shake out. Now, I'm not a conspiracy guy, but I guess I am if you listen to me a little bit, because I think it's bullshit the way that they're doing this as far as the way that these numbers are being reported. I think that this election cycle, they're skewing the numbers to make it look better than it is. I really thought what they were going to do was do their best to get the costs down and get rates lower, to keep the economy from falling apart, to keep it from falling into somewhat of a recession, to have these long, the longest time the Fed has done a cycle. This is, I think, the second longest cycle, past the worst one was in the 80s. I think to keep from it doing long-term damage to the economy, they need to slowly start to let the pressure off. Well, they're not doing that, because I think instead of lowering the rates and helping the American people and then helping their chances of getting reelected, right, because it's always the party in power, what they're doing is they're just trying to tell us that it's not raining when we're getting wet, and telling us, no, the economy is doing great, and when everybody knows and doesn't feel it, right? Credit card balance is up, savings are down, credit defaults are up, but yet they're just telling us how wonderful it is. So I think this is one of the hidden risks that are out there, this phantom debt, and I think this is just a small sliver of the they're telling us what we want to hear kind of thing. This is just one more example of it. So anyway, I hope you guys enjoyed my rant. We'll see if it's true, right? We'll see if it's getting more information on it. It's interesting how a lot of articles and people are talking about this more and more, and maybe it hasn't hit your radar. Maybe this is your first experience with this, but you know, be careful with the buy now, pay later stuff, right? You know, it's not a bad product if you follow through with it, but unfortunately, in the big picture, I don't know if it's great for us. And it wouldn't be so bad maybe if the CFPB kicks in and regulates it, right? Well, thanks guys for watching. You know what? Tomorrow is another rate update video, so please come back for that. Like, subscribe. We got the fake news challenge, Fact or Fiction, coming out at least once a week, and hopefully I'm gonna keep you guys up to date on all this stuff. So hey, if you're looking at buying a home, selling home, you need to get pre-approved, hey, I'm your guy. So call me with any questions. Have a wonderful weekend, and I will talk to you soon. Bye-bye.